we're going to talk about what happens when I discard the fixed asset. And the two most important things here is it fully depreciated or is it not? And what is it worth on my books? Because always that's a key. If it's worth something on your books, if it has a value on your books, then has to be taken off when you get rid of it. So when I have a fixed asset that I'm no longer going to use, sometimes, and if I have no residual value, remember residual value is the value that you could sell it for as scrap when it's no longer useful to you. So you can actually just throw it away. And if I throw it away, or if I get rid of any asset on my books, I need to get rid of, I need to get rid of my asset account and the accumulated depreciation attached to it. So here's an example. We bought equipment for $25,000. It's fully depreciated. That is the key. It had no residual value. So the equipment account on my books had a debit balance of $25,000 and the accumulated depreciation had a credit balance. So when I get rid of it, I'm going to do the opposite to zero out the account. So this is something that's been fully depreciated. Once I get rid of it, both of these two accounts will have a zero balance and they will actually come off my book. So this is the easiest scenario, fully depreciated. Now, when it's not fully depreciated, I have to update the depreciation to date before I remove it. Most of the times we're doing depreciation at the end of the year, but we don't always discard things at the end of the year. So here is an example. We had equipment that cost $6,000 with no residual value and had a straight line rate of 10%, which remember that's 10 years. So 6,000 divided by 10 years would be $600 a month. So the accumulated depreciation balance after adjusting entries at the end of December 31st is $4,650. So $600 a year is how much I depreciate. We decide on March 24th of the next year we want to get rid of it. So we have to update depreciation for 3 months. Remember, when I said if it's after the 15th of the month, it's for the whole month. So I have to do my depreciation for 600 times 3 months out of 12. So I need to update depreciation first, okay? Then I'm going to get rid of it. Once I do this journal entry, my accumulated depreciation will be this plus this, which would be $4,800. And so when I get rid of it, if I just throw it away, here's what happens. So it's $4,800 is the accumulated depreciation. My equipment cost was $6,000. The book value was $1,200. So on my books, it was valued at $1,200. 6,000 minus 4,800 is my book value. So when I have something that I just get rid of and I actually have a value on my books, it's considered a loss of $1,200, which does reduce my taxes. Okay, so here's what you need to remember. You need to know the book value at the time you get rid of it. Whether you throw it away, whether you sell it, it doesn't make a difference. So if I'm selling it instead of just discarding it, then you know that I'm going to get some money for it. So here's the key. First of all, not on this slide, but you have to update depreciation first. And then if your selling price is more than the book value after you've updated depreciation, you have a gain. If the selling price is less, you have a loss. I'm going to show you on the next slide. We had equipment that cost $10,000 with no residual value and straight line of 10%. A 10% rate is 10 years. So 10,000 minus 0 divided by 10 years would be $1,000 a month depreciation. I'm sorry, $1,000 a year. But I sell this for cash on October 12th of the year. So October 12th means that I'm going to go back to October 1st. The balance of the accumulated depreciation in the following, on the last December 31st. So the last time I took depreciation was December 31st. I'm going to get rid of it in October. So my book value is $10,000 and minus the $7,000 that was already in there. My book value right now is $3,000, but it's not fully depreciated, so I will need to update depreciation. Remember, depreciation is $1,000 times 9 months out of 12. So this is 10,000 times 10%, which would be 1,000 times 9 months out of 12. So the $1,000 a year, I'm going to update depreciation by $750. I'm updating it to date. Now my book value is $22,500 because my accumulated depreciation was $7,000. This now gives me $750. So now cost minus accumulated depreciation is book value $22,500. So it's worth $2,250 on my books. Now when I sell it, if I sell it for that much cash, there is no loss, there is no gain. I get the money for $22.50. I have to take these two accounts off the books by debiting and crediting them for the amounts in that actual account. What if I sell it for less than $22.50? What if I sell it for $1,000? So here I only get $1,000, but now I have a loss of $1,250, which is the difference of the book value. What if I sell it for $2,800? So here I get $2,800, so now I have a gain. Notice the gain is on the credit side, the loss was on the debit side. So basically this is like income, and I will end up paying taxes on it. So the key question is what is it worth on your books when you sell it? If you sell it for the same, there's no gain, no loss. If you sell it for less, there's a loss. If you sell it for more, there's a gain. Next, I'm going to talk about natural resources, and then I'm going to be finished with this video. So natural resources are things like timber, minerals, oil, things you pull out of some natural environment. So these are characteristics, and I don't go over these. You can go over them. They are considered a type of fixed asset, except I don't depreciate them. I deplete them. So the formula is similar, but not the same, and I only have one method. Depletion, the formula for this is very much like units of activity or units of output. Cost of my resource divided by estimated total units of the resource. So notice I'm not subtracting residual value. Do not subtract residual value. So whatever I get, whatever rate I get, I will turn around and multiply it times the quantity removed in that period. So here's an example. I paid $400,000 for the mineral deposits. My total estimated units is 1 million tons, and during the first year I got 90,000 tons out. So I'm going to take the cost divided by 1 million tons, which is 40 cents per ton, and then turn around and multiply it times the 90,000 tons. So this is just like units of activity, except there is no residual value. Even if given one, you do not calculate it. So here's what my journal entry would look like. It's just called depletion expense instead of depreciation, and its accumulated depletion is also a contra asset. That concludes this portion of the video.